Ever look at a giant tech company like Google, or I guess I should say Alphabet, and just wonder what really makes it tick? Beyond the search bar, past the phone, what's actually going on inside. Today, we're doing a deep dive into Alphabet Inc. We've got a whole stack of sources here, research, articles, notes, but basically everything we need to break this company down for you.
That's right. And our mission here is to, sift through all this, pull out the really important stuff, understand where Alphabet stands right now, where it looks like it's going, and the big opportunities, and frankly, the significant challenges it's facing. We're talking AI, regulation, big topics. The aim is for you to get the key takeaways without feeling totally buried in detail.
Yeah, think of us as your guides. We'll unpack these sources together. Let's just jump right in.
Yeah.
Okay, so maybe starting with the basics. What is Alphabet exactly? I mean, we all knew Google, then bam, 2015, this parent company structure pops up. Why'd they do that?
Well, that 2015 move was pretty strategic, creating Alphabet, the holding company. It was really about transparency and autonomy. It let the core Google business, the internet services part really focus while separating out those bigger, sometimes riskier ventures, the other bets, they call them.
Oh, right. The other bets.
Yeah. It was about organizing this sprawling empire into clearer buckets, basically.
Got it. So not just a name change, a real reorganization. But with all these different parts, is there still like a single mission guiding them?
Well, the official mission, the one they inherited from Google, is to organize the world's information and make it universally accessible and useful. But while that started with search, obviously it's evolved a lot. Today, that mission applies much more broadly. Think AI, cloud computing. Their vision is really to be a leader in cutting-edge tech. Big focus on innovation, experimentation.
Makes sense. Applying the old mission to new tech frontiers.
Yeah.
Okay, so financially then, how does this giant structure break down? What are the main business buckets we need to get our heads around?
Financially, it's mostly three main segments. You've got Google Services, it's the big engine, the stuff we use daily. Then there's Google Cloud, their fast-growing enterprise piece. And finally, those other bets, the R&D, future-focused stuff. And the structure is key to their stated goal, which is, diversifying revenue away from just ads.
Okay, let's unpack those. Google Services. Sounds like classic Google. How big a piece of the pie is that revenue-wise?
Oh, Google Services is definitely the powerhouse. Our sources show it brought in, around 87% of total revenue in 2024, the vast majority. And within that, search and related stuff, core Google search ads, plus things like Gmail, Maps revenue, that's still the biggest chunk, over 61% of total Alphabet revenue in 2024. $198 billion. So yeah, search is still king.
Wow, over 60% just from search. That's huge. What else falls under services?
Then you have YouTube ads, also very significant, over 10% of total revenue in 2024, $36 billion. And YouTube's in such a unique spot, right? Massive video platform.
Yeah, the second biggest search engine, basically.
Exactly. People search for everything there. Then there's Google Network, smaller and actually shrinking a bit. Less than 1% in 2024, maybe $3 billion or so. And finally, there's this growing non-ad part, subscriptions, platforms, and devices. That was about 11.5% in 2024, over $40 billion.
Okay, what's in that bucket?
That's things like YouTube Premium, YouTube TV subs, Google Play Store sales, Pixel phones, Nest hardware, that kind of stuff. And it showed pretty solid growth, over 16% in 2024, important for diversification even within services.
Interesting. So even services is diversifying a bit. Okay, moving on. Google Cloud. We hear cloud constantly. Is this a really big deal for Alphabet yet?
Yes, absolutely. Google Cloud is growing fast, becoming really important. It was over 13% of revenue in 2024, hit $43 billion. That's way up from just 7% back in 2022. And what's really key here, the sources emphasize this, is the growth rate. Over 30% in 2024, still strong at 28% in Q1 2025.
That growth is impressive, but didn't it used to lose a ton of money? Is that changing?
That's the really interesting part. It hit operational profitability in 2023. And critically, the margins keep improving.
Right. That was a huge milestone for their diversification plan. It offers businesses, infrastructure, platform services, software, computing power, storage, analytics, Google Workspace, and it's foundational for AI deployment, too.
Okay, so cloud's growing fast and starting to make money. Good. Now, the other bets, these sound like wild cards. What exactly are they? Making any money?
Yeah. Other bets is where the, let's say, riskier, longer-term innovation happens. Moonshots, basically. Revenue contribution. Tiny, like 0.5% in 2024, $1.65 billion maybe. And yeah, they consistently lose money operationally, $4.4 billion loss in 2024.
So definitely not adding to profit yet. Which ones are the most prominent?
Waymo's the most visible one, the self-driving car company, and the sources show real progress there. They were doing over 250,000 paid rides a week in Q1 2025.
Yeah, 250,000 a week. Yeah, like a five-fold increase year over year. They're live in Phoenix, SF, Austin, gearing up for Atlanta, DC, Miami. The revenue potential is starting to look, tangible. Estimates are maybe $400 million in 2025, potentially $800 million to $2.4 billion in 2026, plus key partnerships like with Uber.
Mm-hmm.
And then there's DeepMind. Incredibly important. It actually moved out of other bets to be central to Google's overall AI strategy now.
Right, the AI research lab.
Exactly. Engine behind Gemini models, AlphaFold.
Yeah.
The protein structure work that got Demis Hassabis a Nobel Prize in 2024. So its origins show the kind of foundational tech that comes out of this betting culture. Even if it's core now, you also have things like Verily in life sciences, Calico looking at longevity, generally earlier stage though.
So it sounds like Waymo is the closest to maybe paying off among the current other bets, but it's still a portfolio of high-risk, long-haul plays.
Precisely. And, the sources remind us not all bets win. Remember Loon, the balloon internet thing?
Oh, yeah, Loon. And Makani, the energy kites.
Right, those got shut down. Highlights the risk.
So Waymo's traction is good news, but overall, other bets are still costly R&D labs.
Got it. Okay, let's zoom out. The money picture overall. How healthy is Alphabet financially? Are they just a giant profit machine?
Financially. Historically, very strong.
Yeah.
Sustained, solid growth. The sources point to like a 16.7% compound annual growth rate for revenue between 2019 and 2024. Hit a massive $350 billion revenue in 2024. And profit growth, robust. Net income was $100 billion in 2024, up 36%. So, yeah, pretty much a profit machine. And with all those big investments, are margins holding up? Improving even?
Yes, sources indicate margins are improving. Good sign. Gross margin around 58-60% recently. Operating margin hit 32% in 2024, pushed up near 34% in Q1 2025. That's way up from like 27% in 2023. Net margin around 28-38% in that period. So this improvement, even with huge spending, shows good cost control and importantly, better profitability in growth areas like cloud. And return on equity, return on invested capital. Very strong. ROE over 30% in 2024, ROIC over 29%, jumped to over 33% in Q1 25. Shows they're using capital effectively.
Strong margins, high returns. Okay. Balance sheet. Sitting on a big pile of cash for all this investment.
Extremely solid. Sources show a huge cash and investments pile, like $95 billion as of Q1 2025. Debt's really low. Debt equity ratio only 3.4% in March 25. Excellent liquidity. Gives them tons of flexibility.
And what are they doing with all that cash? Sharing any with shareholders. That wasn't always their thing.
Right. That's been a really interesting shift lately. They've definitely increased focus on shareholder returns. They actually started paying dividends in 2024.
Oh, really? Dividends?
Yeah, $7.4 billion paid out. And they just increased the quarterly dividend by 5% in Q1 25. Plus, they have massive share buyback programs, like $62 billion in 2024, authorized another $70 billion in Q1 25.
Wow.
Signals management confidence, gives flexibility for growth, deals, or just returning cash.
Starting dividends, huge buybacks. That is change. Okay, let's look super recent 2024 and Q1 2025. What do those specific quarters tell us about momentum right now?
Yeah, the recent numbers, they confirm that positive momentum the sources talk about. Revenue up 14% in 2024, still strong at 12% in Q1 25, beat expectations actually. Operating income jumped significantly, 33% in 24, 20% in Q1 25. And cloud's continued strong growth is key. Plus, as we said, its improving profitability is really significant. Margin went from 9.4% Q1 24 up to 17.8% in Q1 25.
So cloud's really hitting its financial stride.
Yeah,
That's big. But you mentioned massive capital spending earlier. What did that look like recently?
Yes, exactly. These recent periods also show that ongoing massive capital expenditure. CapEx hit $17.2 billion in Q1 25 alone.
$17 billion in one quarter.
Yep. And sources suggest around $75 billion planned for all of 2025. It's essential for AI and cloud growth. You need data centers, but it definitely eats into free cash flow short term.
Okay. So generating huge cash, but also spending huge cash to build the future. Where exactly is that money going? Especially for future growth, staying ahead.
The growth strategy. It's all about innovation. But the dominant focus, absolutely clear, is artificial intelligence and expanding Google Cloud. Those are the two big engines getting the most investment. That huge CapEx number reflects it.
AI is just everywhere now. How central is it to Alphabet's strategy? Is it in everything?
It's not just part of the strategy, it feels like it is the core strategy now. It's being integrated across basically all products and services. Huge focus on developing and rolling out their Gemini models Pro, Flash, etc. Top priority. They're going into search with AI overviews, Google Assistant, workspace tools like Gmail and Docs, cloud services, everywhere. Gemini 2.5 Pro, for instance, sources say it excels at coding, reasoning tasks, and AI overviews, already used by 1.5 billion users a month. Circle to search usage jumped nearly 40% in Q1 25.
That integration sounds key. And they're building their own hardware for this, right? The TPUs.
Crucially, yes. Massive investment in the underlying AI infrastructure. Their own tensor processing units, TPUs, the 7th gen Ironwood, apparently over 10 times the compute, twice the efficiency. Vital for costs. But they also partner strategically with NVIDIA, offering the latest GPUs like Blackwell on Google Cloud for customers.
So AI improves existing stuff and enables new services. Is that the monetization plan?
Exactly. Monetization happens multiple ways. Better ad targeting, advanced high-margin AI services for cloud customers, and eventually entirely new AI-powered products. Their full-stack approach controlling chips to products is seen as a big competitive edge.
Makes sense. And Google Cloud, what's the specific plan there? Keep the growth going, make it more impactful.
For cloud, yes, strategy's clear. Keep that rapid growth going, 28% in Q1 25 while improving profitability. That 17.8% margin in Q1 was a big jump, shows it's working. They're focusing on high-value services, AI solutions like Vertex AI, data analytics with BigQuery, security. They just announced acquiring Wiz, a cloud security firm, to boost that.
You mentioned demand sometimes outstrips capacity. How does that fit?
Right, sources note that. So meeting that growing demand requires huge data center investment. It's a challenge, maybe leaving some revenue on the table short term.
But also a great sign of strong demand.
Exactly. Validates that massive CapEx. They're also pushing multi-cloud and hybrid strategies, letting customers use Google services wherever their data sits. Flexibility.
It sounds like making these plans real, especially infrastructure for AI and cloud, needs just tons of upfront cash.
Absolutely. That plan's $75 billion CapEx for 2025 really hammers home the scale. It's huge. Impacts short-term cash flow, sure. But the sources frame it as necessary. You have to spend big to compete and lead in these areas. It enables future cloud revenue, powers AI models company-wide.
Are they working with others much or mostly building in-house partnerships?
Oh, strategic partnerships are essential. They can't do it all alone.
Yeah.
Key ones like with NVIDIA for GPUs, crucial. NVIDIA leads there. The Uber partnership for Waymo expansion. They partnered with Samsung to get Gemini AI onto Android devices, their own Pixels and Samsung's S25 line. Millions of devices. Other examples, working with Humane in Saudi Arabia on regional AI. Vodafone for AI customer service on Google Cloud. Fleet management expanding via partners in Europe. These help speed things up, expand reach, get expertise without building everything everywhere themselves.
Okay, innovating internally and partnering externally. Makes sense. But, no company this size operates alone. Who are the main rivals? Where's the competition hottest?
That's right. They compete globally with the other tech giants. Microsoft, Amazon, Apple, Meta. Across talent, market share, user attention, ad budgets, everywhere.
Let's break it down. Core business. Search and ads. Google's dominant, but is that changing?
Google search still has massive global share. Yeah, like 89, 90%. Still the ad revenue engine. But, and the sources really stress this, it's facing a potential paradigm shift. Because of AI competitors, sure, Microsoft Bing is there, smaller share, but pushing AI via OpenAI. But the new competition, AI tools like ChatGpt, Perplexity AI.
Perplexity, right. Heard about that.
Yeah, over 15 million users. These tools give direct answers, not just links. Leads to answer engine optimization, not just SEO. Also seeing more info from places like Reddit, Quora, focus on first-hand expertise.
So AI changing search results, what's the big risk for Google there?
The big risk, highlighted clearly, is AI potentially cannibalizing ad revenue. If you get the answer directly, why click the ad link? How Google balances giving AI answers versus keeping ad clicks healthy. Crucial challenge. Plus, reputation risk if AI answers are wrong, like some early reports on AI overviews mentioned.
That's a huge caution over the core business model. Okay, YouTube. Video dominance challenged?
YouTube's the world leader, over 2.7 billion users. Second biggest search engine, too, but faces intense competition for attention, especially from TikTok.
TikTok, yeah. Huge with short video.
Exactly. TikTok leads short video, 1.59 billion users, crazy high engagement, like 52 minutes a day. YouTube also competes with Netflix, other streamers, video on Instagram, Reels, etc.
How's YouTube fighting back against TikTok?
Wide content range, strong creator monetization, and specifically shorts, their direct competitor format. Sources say short success is vital for keeping creators and users on YouTube.
Okay, Google Cloud. Growing fast, but how does it stack up against the big guys?
It's the solid number 3 player globally, share around 11-13%, but up against the established leaders. AWS still number 1 at 30-31%, though growth is slowing a bit, and Microsoft Azure number 2 around 20-22%. Azure's growing strong, leveraging Microsoft's enterprise ties and OpenAI integration. Some sources even think Azure could pass AWS revenue by 2026.
So clear number 3, trying hard to catch up. What's their edge?
GCP's edge is really in AML capabilities, data analytics, Google's deep expertise there, and their own hardware, the TPUs. The challenge, it's insanely capital intensive, requires huge, constant investment to gain share and just manage the scale. That demand exceeding capacity thing is part of that challenge.
And the broader AI race itself. Beyond just using AI in products, who are they up against in core AI development?
Well, Alphabet, through Google AI and DeepMind, has been an AI research leader for decades, but the competition now is fierce. OpenAI, obviously huge in generative AI with ChatGPT, backed heavily by Microsoft. Microsoft itself integrating AI everywhere. Meta developing Llama, often open source. Amazon pushing AI on AWS. Sources frame it as a battle for talent, data, computing power, speed. Google has strengths, research, infrastructure, data, but faces agile, well-funded rivals. That Microsoft OpenAI alliance seems particularly potent.
Finally, mobile. Seems like a duopoly with Apple. Competition there, or is it more about regulatory risk?
Yeah, Android is the world's most used OS. Basically a duopoly with Apple iOS. Competition in OS, App Store's Play Store versus App Store browsers. But the big flashing light here, strongly highlighted in sources, is regulatory pressure.
Regulatory pressure? How so?
That duopoly structure. Under intense global scrutiny, UK CMA probe, major antitrust lawsuits in the US, Europe. Regulators are looking hard at potential anti-competitive practices. App Store terms favoring their own services in search defaults.
Right.
The outcomes could force major changes, impact app commissions, default search deals, hitting profitability directly. Big time.
Wow, so that dominant position also brings major regulatory baggage.
Yeah.
Okay, given all this, the competition, what are Alphabet's core strengths? What's their moat, and is it holding up?
They have a really powerful set of advantages. Their moat, identified in the sources. First, network effects. Huge ones. Search, YouTube, Android, Play Store. More users improve the product, attract more businesses, attract more users. Virtuous cycle, hard to break. Then, strong brand recognition. Google is globally known, mostly trusted. Massive economies of scale, too. The sheer size of their infrastructure, data centers, networks, chips, creates huge barriers to entry. Deep tech expertise, undeniable. They're at the leading edge in AI. ML areas needing immense talent, long-term investment, vast data assets from billions of users, invaluable for ads, personalization, training AI, plus a strong culture of innovation. Attracts talent, encourages experiments like other bets. And finally, substantial financial resources, that solid balance sheet, strong cash flow, lets them invest big, weather storms, take risks others can't.
Those sound like really solid foundational strengths, but you said the moat is being tested.
That's right. It's definitely being tested by exactly the things we just talked about. Rapid tech change, especially generative AI, could disrupt core search. Competition's heating up everywhere. And critically, that increasing regulatory pressure, antitrust, privacy, AI rules directly target some advantages like network effects, data use. So while Alphabet's overall asset mix is a strength, AI and regulation are significant threats, particularly to search, the foundation of the moat.
Okay, strong foundation, but cracks appearing from tech shifts and external pressures. Let's talk stock. How's Alphabet valued right now, based on these sources?
We can look at valuation a few ways. Traditional ratios like price to earnings, PE, it was around 19x in late May 2025. It's interesting, that's below its historical averages. Like the 5-year average was around 24x, 10-year closer to 28x. So that could suggest it's relatively more attractive now than historically. Or it could mean the market's baking in more risk than before. Regulatory stuff, AI impact on search.
So potentially cheaper than its historical self. How about compared to other big tech?
Price to sales, PS, was around 6.3x recently, within the recent range. Price to free cash flow, PFCF, roughly 28.5 to 30.4x in May 25. Compared to peers, that looks maybe more attractive than Amazon, comparable to Apple or Meta. So yeah, the view from ratios is maybe the lower PE reflects market uncertainties, or maybe signals potential undervaluation if those fears don't fully hit.
Interesting. What about looking at the value of the different pieces, some of the parts? Does that tell a different story?
Right. Some of the parts analysis, SOTP, tries to value each segment separately. One analysis from March 2024 mentioned in the sources actually suggested potential undervaluation of maybe 40-50% compared to the market cap then. It put values like cloud around $600 billion, YouTube maybe $400 billion, search itself 1.3 trillion.
40 to 50% undervalued. That's huge. Why wouldn't the market see that?
Well, SOTP often suggests the market doesn't fully value the sum, especially faster growing bits like cloud or potential like Waymo when just looking at the whole company. Could be the discount is due to focus on search challenges, regulatory clouds, rather than giving full credit to all the pieces.
And what are the analysts saying? Mostly positive.
Generally positive, yeah. Most have buy or strong buy ratings. Average price targets often in the $200 range, highs up to $240, lows maybe $160. But you do see some caution, like Bernstein recently lowered their target, though still market perform. Shows analysts are reflecting those uncertainties too, AI, regulation.
So despite risks, valuation looks potentially reasonable versus history and peers, and analysts mostly optimistic.
That seems to be the picture from the sources, looking at the numbers and commentary, yes.
Okay, let's pull it all together then. Based on everything we've dug into, the businesses, finances, investments, competition, risks, what's the overall investment picture here?
The sources lay out a clear case. Pros and cons, arguments for. Market leadership search, ads, YouTube. Top-tier AI innovation, huge investment there. Strong financials, growth, profitability, cash flow, balance sheet. Significant growth potential too. Cloud, now profitable and scaling. Other bets, especially Waymo, showing progress. Potentially attractive valuation like we just discussed. And increasing shareholder returns, dividends now, big buybacks.
Compelling positives. But the risks sounded pretty major too.
Absolutely. Critical points of caution. The major one. Regulatory risk. Antitrust lawsuits could force big changes, big fines. Competition is intense everywhere. Generative AI could disrupt search. Strong rivals in cloud, AI, video. Uncertainty around AI monetization in search will cannibalize ads. Huge investment costs hit near-term cash flow. Other bets still losing money, uncertain payoffs. And founder control limits, shareholder influence.
So lots of upside potential, but fundamental challenges, external threats. What could really move the stock positively? Catalysts.
Potential catalysts. Successfully monetizing AI in Search Cloud, especially if it drives new revenue. Continued strong growth and better profits in cloud would be huge. Major progress for Waymo, more cities, real revenue. Favorable antitrust outcomes, less harsh than feared, would lift a big cloud. Disruptive new products. More aggressive shareholder returns.
And what are the crucial things to watch out for, the potential negatives?
Watch closely. Any big changes in search market share due to AI. Outcomes of regulatory decisions, absolutely critical. Progress of key competitors, Microsoft OpenAI, Amazon Cloud, global ad market trends, Alphabet's ability to manage those huge costs, CapEx, R&D, and any major issues with AI reliability, bias, ethics. Could a hit reputation bring more regulation?
Okay, so weighing all that up from the sources,
Yeah.
the strengths, risks, financials, catalysts, watch points, what's the final takeaway? The recommendation.
Based on the analysis in the sources, the recommendation leans towards a B way. The justification really comes down to Alphabet's fundamental strength. Its tech leadership, innovation power, especially in AI, robust financials, cloud growth and profitability, the potential in other bets like Waymo. The valuation seems reasonable, possibly already factoring in some of those risks. They have the resources, the position to navigate challenges and create long-term value, especially as AI drives more of the economy. But, and it's a big bet, but the sources emphasize those high regulatory and competitive risks are very real. Need careful management by the company and close monitoring by anyone invested.
Wow, that was definitely a deep dive. It's so clear. Alphabet is this incredible powerhouse, amazing assets, huge potential in AI and cloud, but also navigating some serious storms. AI changing search, regulators watching closely.
Absolutely. The sources really capture that tension, don't they? Being right at the forefront of tech, but also facing these fundamental questions. How will the core business evolve? How will governments let them operate?
Yeah, it really makes you wonder, how will getting information change as AI gets better at just giving answers? What does that mean for Google's business? Sure, but also the whole online ecosystem that grew up around search traffic.
Right. And how does a company this massive, under such scrutiny, keep innovating fast, keep growing, while managing risks, satisfying regulators, keeping trust? That's the tightrope walk the sources suggest they're on. Can they maintain dominance while adapting? Big question.
A lot to chew on there. Thanks for joining us on this deep dive, unpacking all these sources.
My pleasure. Hopefully it gave you some valuable insights, a clearer picture of this really fascinating, complex company trying to shape the future.
Definitely did. Until the next deep dive.